Welcome to the Rapid Recap. It is August 20th, 2015, and today's lesson is evaluating the quality of your stock trades. I'm Sasha Evdakov, and thanks for joining me. Now, this last couple of weeks, we were actually away from the office area, and we were spending some time in Canada. So the rapid recaps and the things that I was working on maybe were not as good as I hoped, and I had some ideas on our vacation to make things better. So anytime that you go away, have a clear mental thought. We were relaxing by the lakes, going canoeing, kayaking, boating, and celebrating a 50th wedding anniversary over there, and also went to a war museum, light show, a lot of different things. You can do a lot of things in 2 weeks and really rebalance and recalibrate yourself. Now, I still did have some stock trades that were on, and you're just watching closely and carefully, and a lot of those were based on the discussions that we've had before. So we'll go over a few of those positions, but really about one main specific company or trade in particular. So we'll go over in detail about that. But now that I'm back in the office area, things are a little bit easier to work on in terms of video recording. So what I want to do is do something a little more visual. So what we'll do is we'll go through the rapid recap and talk about the Dow Jones, S&P, Apple, Netflix, Facebook, CMG, and Tesla. And I want to incorporate some of these visuals here within today's lesson as well. And that is just because I know sometimes the rapid recaps, I don't tie in as much visuals that are to regular life as I do with other Tuesday lessons that we tend to do or regular lessons on YouTube. So today, my goal is to make them a little bit more connected to the real world because I know sometimes the market can be confusing. So I want to apply the lesson a little bit more visual. If you're members of the critical charts, I posted some of these charts over there in the critical charts. So go ahead and log in and check those out, as well as the notes that are associated with them. In either case, today's rapid recap, our focus is really about evaluating the quality of your stock trades. And based on how the market's been acting and performing, it's no surprise that we get a little bit of a sell-off. Now, when it comes to the real world and the real world application of how we choose things based on quality, not everybody chooses the cheapest thing and not everybody chooses the most expensive thing. If that happened, we would be wearing the same clothes, just similar to this Waldo character over here. So take a look here. We would probably be wearing the same kind of clothes, the same kind of jeans, the same kind of shoes as everybody else, if everybody chose the cheapest thing possible in terms of their buying selection. And this goes along with the same thing with stocks that we'll apply to in a little bit. So if we were to always choose the most expensive thing, the same thing would happen, is we would all be running and doing the same thing in terms of driving the same cars, eating out at the same restaurants. So because that doesn't happen, we all have a different valuation of quality. And what does quality mean to us? So you have to remember, if you're asking me questions about which stock looks good, I base it on my quality perspective. Okay, you have to evaluate things based on your quality perspective when choosing stocks. So we'll get into this in a second and tie it together. So when you're looking to purchase, let's say, candy here or a chocolate bar, you have a truffle here that's worth $250. So you can choose this truffle and eat that one time, and it's going to cost you $250. The other route you could take is just have some general candy, which may cost you $5, or you could have something mid-grade that's, somewhere in between the $250 and $5, like the Lindor truffles here. So a little bit of a different kind of chocolate than the $5 candy or the very expensive premium grade truffle. So for me, when it comes to trading stocks, and my investments, I'm looking for the most expensive truffle I can find. I'm looking for the most premium stock that I can get. Premium meaning the most high quality stock I can get. Okay, and that is because I want less risk. I'm very risk averse. I don't like risk. And I want high quality return. I'd rather have one really good stock than thousands of pieces of candy or thousands of other stocks that are just so-so or okay. I'd rather than just not trade and sit in cash. Okay, I'd rather just wait for the opportunity. That is my quality spectrum when it comes to stock picking. Now, when it comes to a car example, let's just talk about cars because I think it's easy to relate. A lot of people are looking for, especially if they're more males, they're looking for a high-end premium car. You could choose your quality based on, again, they want the highest quality everything, so then they would choose the Truffle, they would choose Lamborghini, and so forth. But you can't always get the highest quality in everything. So in this case, let's take a look at this example. So we have a Lamborghini, and many people would choose a Lamborghini instead of having something else. They would say, okay, I want the highest quality Lamborghini, but I'll eat the $5 candy, okay? Or I'll have the multi-million-dollar house, but I'm going to eat the cheapest food that doesn't taste good. So there's a different kind of valuation or value that's associated in that person's mindset. So for some people, they'll choose a Lamborghini. They'll have one car rather than, let's say, you have two Audis. Okay, so for another person, they might rather have two different cars, either two of the same cars or two different cars, mid-range. So let's just say this is the mid-range valuation in terms of vehicles. And then for other people, you have multiple Toyotas. So again, the valuation is really different. And it might shock you or surprise you, or maybe it doesn't. For me, I'm actually the multiple Toyotas person. In fact, I drive a Toyota. So for me, the value of a car is really not that important. I don't really care about how my car is, what it looks like, because of the social status. To me, is just not important. In fact, I want to be more camouflaged and hidden about that. Can we purchase an Audi? Yeah. Can we purchase two Audis? Of course, no problem. We can buy them with cash. Can we buy a Lamborghini? Yes, of course. But is it important in terms of the quality for me? The quality for me here, when it comes to a car, what I want is I want reliability. And if one breaks, I'll buy a second one or a third one or a fourth one. It really is a no headache kind of thing for me, okay? Now, when it comes to stocks, I want the Truffle. I want the most expensive, best stock in terms of what's on the list. Not necessarily expensive in terms of price, but the highest grade quality. That's what I'm looking for. And the highest grade quality, I'm not talking about to the long side or the short side. I'm talking the highest quality, meaning the highest probability or percentage of reward. That's what I want from my stock trades or investments, or whether I'm doing option spreads, calendar spreads, iron condors. I want the best of the best. When it comes to cars, I want kind of something the most reliable. Okay, so it depends on your quality valuation. So you have to determine where are you in terms of your candy or car example. Are you more of the Truffle person, or would you rather make a few more trades in between, such as like something like this candy right here? Let's just say it's mid-range. So make a few trades, or would you rather make a ton of trades but only make a little bit of dollars? So when you're talking about the Truffle, you'll make one or two trades and you'll make a lot more from those few trades. When you're doing something candy, like a Lindor Truffle, like something mid-grade, then you might make a dozen trades and then get decent reward. When you're talking about just cheap candy or just very discounted things, you're going to have to make hundreds of trades or a lot more trades in order to capitalize and get a good return. So let's take a look at some of these stocks and some of these indices and how things are moving. And then I'll share with you about my current position and just some other things I'm watching. So Dow Jones is basically looking at this support line right here. When we're looking at this support line, you notice it's starting to break right here, and we accelerated midday there, and we're down 353 points. Now, we went sideways for quite a while, and if you take a look at this weekly, you can see things are starting to roll over. Take a look at the daily. You can see some volume picking up, and if you really want to see true volume, take a look at the diamonds. You'll notice the diamonds over here. Here's the volume spread right here. You can see it's picking up, accelerating to the downside. You would have seen it the other day breaking. And then over here, we're just accelerating and continuing that pattern. So if we take a look at the diamonds, the same concept's playing out, okay? So be careful as we start approaching certain levels because you will get bounces once things are oversold a bit. But look at these levels and how they're coming in, okay? So it's the same thing over here. So here it is. Here's our support lines. The indices starting to break it. 42 points down for the S&P. That's huge, huge. And you can look at this on the spiders as well. We're basically coming into that level and starting to accelerate downward. So we could see much lower prices over here, at least to about the 197, I would guess 198. So just be mindful and be careful of how things are moving into your stock. All right, so that's kind of the indices. Let's get into the stocks themselves. So for me, the first one I want to discuss, and this is the largest position that we have, is a short on Apple. Now, I've been talking about this stock for months, between the critical charts, between the rapid recaps, and that is because I saw it setting up. There's a lot of things that I saw setting up, and I'm not going to cover them too much in detail here, just because we've dwelled on it along with the earlier ABCD pattern. But I've noticed the rejection here. I noticed it come back to test this, okay, and then the break here. Okay, so you could have been shorting it right here at these different points, or when the stock bounced right here, that was just the dead count bounce, and then right here was another shorting opportunity when it rejected at this 20-day moving average. Now, if you wanted to be safe, you could have definitely waited till we came and broke this level or even this level, and you still, even if you waited, you still would be up 6 points, and 1,000 shares, $6,000 right there in a few days. Now, we had some people talking, saying that it could come back and go even higher and push even higher. My prediction, when you know how stocks move and behave, right here, that it would come back here, because this is also our 200-day moving average, as you can see, come back to here, and this is where the 20 days crossing over, reject it at that level, and then sell off. But we couldn't even get to that level, and that stock continues to move and roll over. So we do a little pop, and then we sell off. We pop, and we sell off. So this stock's just moving simply in the terms of when it pops, it's just a selling opportunity for the time being. Now, you should be taking profits into strength every time it goes in your favor, just to reduce your risk, because you never know when you'll get those bounces. But watch and be mindful of how the stock's coming into this level. And this right here is our largest shorting position. Now, in terms of trading, when you trade stocks, whether you're trading just a single stock, just 2-3 stocks, or 5-7 stocks, diversification, I think, is great when you're running $5, $7, $10 million portfolio. But if you're trading less than $100,000, there's a video I did not too long ago. You really don't need to be trading more than 4 or 5 stocks, and that is just because of your mental clarity. Now, this is my truffle right now. This is what we have. This is our truffle. We do have a couple other positions on that are much smaller, more like a Lindor, or some of the other candy pieces, just to see how those things go. But really, this is the truffle that we have. This is the biggest position that we have on the short. And, for other people, they may be trading 4 or 5 stocks, but on a smaller level for diversification purposes. And that's okay. It depends on how you judge and base your quality. Remember what we talked about in our lesson. So are you the person that you would rather have, 1 car, 2 cars, or 4 or 5 cars? Are you the person that wants the truffle, or do you want to manage a couple of positions, something mid-range, or are you the person that just wants a whole bunch of positions? But keep in mind which one is probably the more healthier option for you, or the better quality, right? Chances are the truffle is going to be better quality. Chocolate's not, I don't know if it's that healthy for you. I wouldn't call it healthy in terms of my level of health. You know, salads and fruits, I would say, are much more healthy. But in terms of these kinds of chocolates or these kinds of candies, would you rather have candy that's filled with sugar, or would you rather have a truffle that's more premium grade chocolate? So you got to look at your spectrum and see where that plays out. So do you want to have a lot of positions on and have a lot of sugar and be on a sugar high, or are you looking to have something that's just really high end and manage it and just focus on that? How do you want to trade? How do you want to manage your portfolio? You have to decide that. For some people, they love trading 15, 25 times a day. For me, I would rather trade once or twice a week or once or twice a month and hold that position for a couple of weeks, for a couple of months, and let it run. I would rather do that because that's when the big money is made. Okay, so the same thing here when you have, let's just take a look at Netflix over here. Okay, so here we have our stair-step pattern. Okay, so here was our, let's just talk here. Resistance 1, resistance 2. Here is your entry point right there. Okay, so that's your entry point. Breakout on heavy volume. That is your signal. Next entry point or adding opportunity. Boom. And then you're taking some profits into strength here. As we power higher, take some profits somewhere around here. And then again, you can enter and add to your position. And then again, you can add to your position, but remember, you should have been selling some into strength around here. And now this line right here, that line broke, okay? That stock broke that line. So right here, you should be out. You're out. I'm exiting right there. That's your exit point. Bearish bar, huge sell-off, volumes picking up. Okay, you want to be careful and mindful. Now, if you had a more wider stop, you could use something like this as your stop at this level. If you got in it somewhere around here and you took some profits around here, then you could use that $100 level as your stop. But in general, if you're keeping tight stops, you're peeling stuff into strength and raising your stop. And then once it breaks that stop, you're out. That's it. You're just moving up. No negotiating. No ifs, ands, or buts. Okay, so there you go. There's another stock. Facebook, same thing. Weekly. This is a weekly chart. But really, look at this gain that you could have had 10 points. 10 points. Okay, let's just say you had 5,000 shares. 5,000 shares times 10 points, $50,000. Let's just simplify things. Let's just say you had 500 shares. 500 shares, 10 points, $5,000. If you had, let's just say 50 shares. 50 shares times 10, $500. Okay, 50 times 10, 500. Okay, so even then, you're holding it for 28 days. That's a month. That's a month holding period where you don't have to do anything. You could go enjoy the beach. You can go relax. You can go kayak. You can go canoe. You can go play tennis. You can go do whatever you want. And when the stock comes back, let's just say you set a stop somewhere over here. Stock comes back, okay, right around this level. Boom, you would be out right there. Stock is breaking it, or even right here, okay, definitely out. Okay, but looking at this stock right here, here's our entry point, adding point, taking profits into strength somewhere around here because you have that gap right there. Okay, the stock is selling off pretty heavy of an accelerated volume, and that is also because the market itself is selling off, so you want to be mindful. Always the leaders, these leading stocks usually sell off first and then everybody else follows because many people are trading these. This includes things like the CMG. Okay, so looking at this one trades lighter volume, so you want to be mindful, but look at this line right here. Use that line as support if you were in this stock. Now, we're not in this one anymore, but if you were in this stock right here and you got in it when it broke this descending trend line right here, allowed it to run, you know, I know we had some earnings right here, so you probably got out of it, and then maybe you got back in it right around here, and then maybe traded and took some profits into strength. But even right there, at that point and level, even if you got in its second day after earnings, you still had a 23-point gain. Okay, so from right here to 726 to 753, that's still a 20-point gain. Okay, and then you're using this right here as your stop. Nothing wrong with, taking profits into strength or being patient, being mindful, and, not even trading earnings. You can wait and you can still capitalize on that run. Okay, so CMG right here, watch that line for a potential break. I wouldn't short it here. I would just, if you're long, I would use that as a stop. With Facebook right here, if you're long, I would have been out today for sure. If not somewhere right here on July 30th, probably, or maybe August 6th. And that is just because it's showing some red flag signals. Now, can this stock fill this gap right here or come back to retest this level and bounce? Absolutely. And that's the opportunity to get back in. But you're always taking profits into strength, and here was your break, and you take profits, and you allow it for a 10-point run. Even if you got only half of that, let's say 4-point, 5-point, what's wrong with that? 5 points, even if you miss part of the run. 5 points is 5 points, right? Waiting for the break, and then you're letting it run for 20 days. That's a 20-day run. And then finally, we got Tesla that we're talking about. Now, Tesla is an interesting stock because it's highly shorted. You have resistance right here at these swing points right here. So you want to be mindful that this stock has that resistance line there, and then it came up, rejected it. There's the higher volume bar, and we continue to sell off 13 points today. If you look at the daily, you can see that we what we do is we sell off, we power higher, we sell off, we power a little higher. But overall, take the highs of that swing point and go to where they are, and you'll see the trend, okay? So there's our trend. If you just draw a resistance line, there's your resistance line, and that's what our stock is doing, okay? Looking at overall the weekly volume, it's a little tricky to see this one, but not the previous week. The previous week was a bounce, but the week before that, you can see we did 30.7 million shares to the downside. Then we bounced on 21 million. So this week isn't over yet. We still have one day, but look, we almost have 20 million shares to the downside, whereas we had 21 million shares to the upside last week. So we still have one more day, and chances are we'll probably surpass that 21 million because we're trading. Let's say our average trade is about 3.64 million, 4.5 million. So if we do that much for the week, we will get about 23 million, 24 million shares to the downside, whereas 21 million to the upside was the previous week. So that's kind of my insight for the stocks. I know I didn't share with you a ton of different stock picks, but I hope the lesson was insightful and good. There's some other companies like a GoPro as well you could short. You can see right here, we talked about this also in the charts before. I haven't posted these stocks back in the critical charts, and there's no sense to discuss them because they're already in there. The charts and the lines from the previous week still apply, and same with the rapid recaps. The rapid recaps that we discussed from the past, these still apply, these charts and trends. You notice right here we had our swing points right here, swing point here, rejection here, and rejection here, played around, and then we had a sell-off. So the stock, it's not acting as strong, but looking at the quality, how is the quality? What kind of stocks do you want to trade? Or you could trade cheaper stocks like this Rad Corp. This is like your gummy bears and candy and so forth. Or even like a Sprint $4 stock, right? So you could be trading these kinds of stocks, or you could be trading the more higher quality companies. And it really comes down to the type of trader that you are, the type of trading that you want to do. Remember what I said about the truffle versus the Lindor chocolates versus the gummy bears or the sugar candy. What kind of quality do you want from your investments? Same thing with a car example. what kind of quality do you want? Do you want to be in the best of the best? Do you want to be in the mid-range, or do you want to be somewhere where you have more reliability or potential that if anything goes wrong, you're not that upset that it happened? If we apply this concept to clothes here, I've just put it in. Again, are you looking for higher end clothing, or are you the person that wants something a little bit cheaper, like beach clothing, or something more relaxed? Something where you don't have to worry about, your appearance. Something that's just more loose fitting. Again, what is it that you value? So, what is it that you value in the sense of other items, things, and pieces? And then apply it to the stock market. How do you value different stocks? Do you want to be the person that's, has a bunch of stocks that are mid-range? Do you want to be the type of investor or trader that has a lot of cheap quality stocks in your portfolio, but hoping to do a lot of turnover, like, with the candy, trying to sell a bunch of them? Or would you rather just trade a handful of times per year the really good quality picks, and then have more of a, relaxed, calming trading atmosphere? Sometimes it's difficult to put yourself in one area or another just because you're going against your psychology, you're going against your mental training and habits that you've developed over time. So if you're always the person that's always looking for something high-end, high quality, the best of the best, it may be a good thing for stocks because that's what you're looking for then in stocks. But if you're always looking for deals, if you're always looking for something cheaper all the time, trying to save a few bucks here and there, then it may be not a good thing. But you really have to cater to what fits and works for you. There's a video that I've made on YouTube that, whether you're a bear or an alligator, and if they got in a fight, which one would win? Well, it really depends on the context. If you are in the forest, chances are the bear. If you're in the swamp, chances are the alligator. But it comes down to the context. So you have to determine and decide whether you're the bear or the alligator, and what type of pace you're moving within your stock trades, your investments, and so forth. For me, I'm more of a calm trader. I like to, I don't like to chase things. And that's one of the things that has made me a little bit more successful, whether it comes to stocks, whether it comes to business, education. I really dig deeper into things and material because I'm looking for the right opportunities to get into those positions. And it really comes down to one word. It comes down to patience. So look at the quality, evaluate things. There's nothing wrong with trading stocks that are cheaper. There's nothing wrong with trading stocks that are higher grade. It's just to understand that they trade slightly differently, and that they also, you have to be mindful that the trading that you're going to be doing when you need to trade more frequently is going to be different than when you're trading on a more calm and patient level. Where do you fall, and where do you want to fall within that quality spectrum within your trades? Hopefully you got a lot out of this video. Thanks for joining me. I truly appreciate the fellowship. Got some great things coming, working on a few books, and I'm actually working on a couple of business books as well. But we got a couple of things working on the stock market, still working on the options course, and moving that forward, as well as the penny stock book. Just because with penny stocks, they're actually a lot tougher to trade, in my opinion, because there's more manipulation. But if you study the charts, it really kind of gives you an edge to spot those subtle signals. So really that's why I like studying all kinds of charts, because those cheaper stocks actually get manipulated, and you can learn so much more by reading those lines in between and just looking at those subtle signals. So in either case, we're working on that penny stock book. We're also working on that options course, and I'm still aiming to do a few more broker reviews by the end of the summer. So we'll try and get that wrapped up as well. Thanks for joining me. Hope you have a great week ahead. Spend some time with your family, your friends. Enjoy the weekend. Maybe go grab a nice bite out to eat, or cook something delicious for yourself and just enjoy it. All right. Thanks again. And remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time. Take care.